Hi and welcome to Macro Monday, where we talk macro and find out if Steve learned how to use his microphone since Friday. So just as a point of clarification, I didn't actually change any of my mic settings on Friday. I updated Windows earlier that week, and I have a rule. When the settings are where they need to be, don't change them. So I don't know if something did change, but hopefully this sounds a lot better. Welcome, I'm Steve Van Metre, and thanks for joining me today where we try to figure out if Jerome Powell is going to announce yield control curve at the upcoming Fomc presser on Wednesday. Now, before we get to that, we have the big elephant in the room to deal with. Many of you have called me out in the comments on this over, say, the last month and a half. You send me emails, Twitter messages, the smoking gun that proves Steve's thesis wrong because he refuses and avoids every conversation about this topic. And because he avoids it, well, it must be the total thesis busting deal that he doesn't want us to know about. When in fact, that is not true at all. I spend every day trying to punch holes in my own thesis. I'm far more adept at it than probably most of you understand. And no, the corporate and high yield bond purchase program by the Fed does not bust my thesis at all. Sorry to say, it doesn't bust it. Now, many of you have called me out saying, hey, you don't talk about this. You're avoiding it. So what's the deal? Well, the deal is I've already talked about it twice. I've actually done 2 shows. Some of you might remember where I used my trash can as an example for the Fed special purchase vehicle. In fact, I did 1 show. People said I didn't cover, so I had to do a 2nd show. And I've even talked about it in some of my interviews. So we have 2.5 shows worth of me talking about this thing, and it has nothing to do with my thesis. I've talked about whether I thought it was inflationary or not, and yet so many people seem to think that I'm avoiding this. Well, no, I just have no interest in it. I've covered it twice. It means nothing to me. I'm not interested in it. So here we're going to go. Number 3, let me show you where you can find out about this corporate bond purchase program. You can go to the Fed's website under H.4.1, and you can scroll down to net portfolio holdings of, that's not it, net portfolio holdings of corporate credit facilities, LLC. And you can see they currently hold a little over $44 billion in corporate and high yield bonds. Now, I went to the Fred database, so the St. Louis Fed database, and I found the net portfolio holdings of corporate credit facility, LLC. And I pulled it up. And it said, since the end of July, the Fed has purchased about $580 million worth of corporate and high yield bonds. Nothing. I mean, just nothing really going on here. And yet people say, but Steve, this is so inflationary. This is the smoking gun. All right, well, let's add on what's going on with the CPI, and we will overlay it here so you can see, because I don't really think this is inflationary, but everyone thinks it is. For some strange reason, I don't know. Then we go to percentage change from a year ago, and voila, there you have it. Zoom in, and no real relationship there. The Fed actually started the bond purchase program after consumer price index on a year-over-year basis started moving off of its bottom. If this is correct, that means consumer price index needs to go up and then presumably must flatten out. I mean, everyone says, again, this is inflationary. They also claim that this is something to do with the stock market. This is the reason the stock market's going up. And I've said, no, I don't think so. Everyone claims that, yes, companies are borrowing money to buy their stock back, and they're using the Fed to do this. Well, that's not quite true. Let's go and look here. But remember, this is infinite share buybacks. This is what people believe. And sure enough, the stock market bottomed well ahead of this Fed program. In fact, if this is accurate, I mean, I'm not saying that the chart's not accurate. It is accurate because I'm graphing it. Then why didn't the stock market shoot straight up from the point where the Fed started? And it didn't. In fact, it's slightly higher from where the Fed did, but certainly nothing to indicate that corporations are out rampantly buying their shares back and selling it to the Fed. You got to understand, just because the Fed owns something does not exempt the interest payments. It does not exempt when the bond comes due that it has to be paid off. Many of you that have mortgages, there's a high probability if you have a government-insured mortgage that the Fed owns your mortgage. Are you exempt from making payments because the Fed owns it? No. Did you get a letter in the mail say, hey, congratulations, the Fed bought your mortgage. From now on, you don't have to make a payment? No. Just the ownership has changed. That's all it matters. Instead of someone in the a private sector who maybe a mutual fund or an ETF or a private investor who buys corporate bonds, it's owned by the Fed. It does not exempt anybody from having to make regular payments or deal with the bond when it matures. And it also does not imply that all these companies are suddenly doing infinite share buybacks to drive stock prices higher because the Fed has intervened in the market. That there's no evidence to support that. Yes, now of course the Fed is buying some Apple bonds and they don't need the money, so we know that they're doing it for share buybacks, but that doesn't mean everyone else is. And there's no evidence that these things are inflationary at all. So there you have it. No smoking gun, no surprise. There's the inflation generator of coming out of the Fed from the corporate and high yield bond market. It has nothing to do with it. The reason the Fed did this, and I'll say it again, is there was so much issuance, or the Fed knew there was going to be so much issuance because all these corporations were pulling their short-term line of credit. And the Fed knew that these companies were going to use that money to stay in business, and then they were going to go out to the bond market or perhaps the equity market and issue new shares. So they were going to mostly issue new debt to pay back the revolver. That was the whole point. The Fed knew that. But the problem is the high yield bond market, the corporate bond market is only so big. There's only so many people that want to buy corporate debt. Well, there's a second problem is if you jam the corporate bond market full of new issuance, guess what happens to corporate interest rates? They go up. The Fed doesn't want that. So the Fed needed to take some pressure off that. They also knew some of these companies were going to have financial issues, and their debt was eventually going to be downgraded to the high yield space. Well, guess what? There's only so many people, so much money that goes into the high yield space. And if you have a flood of money going in there, what happens to high yield rates? They go up. So all the Fed was doing is taking pressure off of this. It was not some massive inflationary tool to create infinite share buybacks. And you can see the charts. You can go pull them up on the Federal Reserve website yourself and see this isn't what people think. And so the reason I haven't talked about it, because I already did twice, and it really doesn't have zero impact on my thesis. And if you think it does, then unfortunately you really don't understand my thesis, and I have not done a good job of communicating that with you. Now, on to the Fed. So we know on Wednesday, Fed Chair Powell will speak. He has a press conference lined up. The meeting starts tomorrow. The bond market was kind of just teetering today, just pretty even. Tomorrow's a 20-year bond auction. We found out today there's a renewal of quantitative easing, as I've said. So what is Fed Chair Powell going to do? Is he going to talk about yield control curve? And the answer is probably not. So what is it? For those of you who do not know what yield curve control is, you can go to the St. Louis Fed website, find the On Economy blog under blogs and publications, type in what is yield curve control, and you'll get this article dated August 11th. And it's really fantastic because it tells you exactly what it is. And it says the yield curve control aims to control interest rates among some portion of the yield curve. The curve is usually defined as a range of yields on Treasury securities from 3-month bills to 30-year bonds. However, yield curve control targets longer-term rates directly by imposing interest rate caps on particular maturities. So what it means is if bond prices of targeted maturities, so we'll say if bond prices of 30-year bonds remain above the floor, the Fed does nothing. If the price of, say, 30-year bonds fall below the floor, the central bank buys them until it moves back where it needs to be. So why is the Fed not going to do it? Well, they don't need to. They have quantitative easing, and quantitative easing, as we've already talked about, is designed to lower or suppress interest rates, just depending on the scale and the target of what a central bank is doing. So in order for yield curve control to matter, all it is just it's a version of quantitative easing that says thou shalt not cross this line. So it says, look, if interest rates go up, you hit here and you stop. You do not go through. Whereas right now they can go up and fluctuate around if they need to. And we see that in the market. But if we had yield curve control, that would end. But we don't need that. Now, why don't we need it? Well, I'm going to show you a chart of 30-year treasury yields here. And I've gone back on my trading software. And I've gone back as far as it will possibly go. Back to 1987. This is 30-year treasury yields. Does this look like a chart where we have a problem with rising interest rates that need to be controlled? The answer is no. It does not. In fact, it looks completely opposite of that. The Fed doesn't need to control long rates or even 10-year yields because there's no problem. There's no problem in the bond market that's suggesting that interest rates are going to spike. So what are we going to hear from Fed Chair Powell? We're not going to hear yield control curve. We might hear a blurb on it. He's going to talk about average inflation targeting, which is just some fancy mumbo jumbo that translates to this. In the past, when the Fed hit their 2% target, they would immediately begin tapering their program, say quantitative easing. Perhaps they would scale it back, perhaps even raise the federal funds rate. Now, what they're going to do is say there's an average, and based on multiple metrics of inflation, we're going to wait until the midpoint, the average, is at 2%, and then we're going to start scaling back. Now, you'll understand that it doesn't mean the Fed is going to get to 2%. It's just going to mean if the average gets there, then they will start tapering. That's all it means. It means nothing else. But yet the market will make it out to be possibly more than it is. But that will come Wednesday. And also coming Wednesday, I have some new lights coming in, so maybe things will look a lot better. Let's look at how hedge funds are positioned. And I want to kind of reiterate why yield curve control just isn't going to happen. So let's take a look at 10-year treasury notes. These speculative positions went from short to slightly long. Nothing really going on here. We know that yields do not bottom until speculators are at a long position. But look at the 30-year bond. I mean, effectively the longest. I mean, very slightly less than the largest speculative short position. Now imagine this. So 30-year yields are right around, let me look today, they're 1.4%. So just say we're at 1.4. Now imagine for a moment, the Fed comes out on Wednesday and Powell says, hey, we've decided to cap 30-year yields at 0.5%. What do you think is going to happen to all these people that are short bonds? Not just the speculators, but everybody in a whole country, whole world that are short treasuries. They're going to get obliterated. Because they would lose money in literally an instant. As soon as his mouth said, we are capping 30-year yields at 0.5%, the market would immediately slam bond prices higher. All these short people would get just obliterated out of their positions. He's not going to do that. And what's even more interesting to me is you have all these people betting on higher interest rates, and the 30-year yield's still 1.4%. Wow, imagine where it's going to be when all of these speculators are long. And people wonder why he keeps saying yields are headed to or close to zero, even at the long end of the curve. It's because all the speculative bets against it. How about West Texas Intermediate? Speculators backed off a little bit. We're seeing oil roll over and head down. For those looking for inflation, the oil market is certainly not telling you that the rising prices are coming as we see oil prices roll over and head down. How about the S&P 500? Speculators switched slightly long. Looking at the euro, which in the trade-weighted dollar is a big factor. The euro is a huge component of the trade-weighted dollar. This is one of the reasons the dollar is as low as it is because everyone's betting on a rising euro. Wait till this unwinds. People say the dollar is only headed down. It tells you when you have the largest speculative long position in the euro, is probably the opposite is going to happen. But market is what it is. Let's take a look at gold. We're not seeing really any changes there in speculative positioning. And looking at the NASDAQ, speculators went short, chasing tech stocks down last week as the NASDAQ dropped. And small caps still, speculators slightly long as small caps rolled over. And then we've got the dollar, which is forming a bottoming pattern. I think the dollar could easily be making a similar move here. This was a 3-month bottom. If that's the case, we're 2 months in, potentially another month. And then all of a sudden you're looking at the dollar headed higher. And you've got a big short position sitting down here. And last but not least, you've got VIX futures. So betting that the market is not going to be volatile. So the VIX is a volatility index. When people are short VIX, they're suppressing or trying to suppress volatility. And last but not least, let's head over to the New York Fed, where today there was no quantitative easing purchase, but we did have a renewal of the program as I suspected we would. We're seeing the same 9-day schedule, just a slightly different order. It resumes tomorrow, and then it skips on the day of the Powell presser. That's fairly standard. But notice there's 1, 2, 3 purchases of a long bond between now and the end of the month. So again, same 9-day schedule, just slightly different order. And anyone that thinks that long rates are headed higher, well, you could still like and you could still subscribe, because I'm still your friend. Even if you disagree with my thesis, it's totally okay. But now you know, for the third time, we've covered why Steve does not care about the corporate bond market, corporate and high yield bond purchase program, because it really doesn't do anything. So I'm Steve Van Metre. We'll be back on Wednesday where we'll talk about what's going on with the Fed and some whatever other interesting things happen in the market between now and then. Thanks for watching. I'll see you then. Bye now. The content of this video provides education information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in this video that do not reflect the view of Alice Financial Advising or Steven Van Metre Financial.